We work hard for our money, and when we finally have some left over, the instinct is to lock it away in a bank account. There is a comfort in knowing exactly where your cash is. If you deposit $10,000 today, you expect to see exactly $10,000 tomorrow. It feels safe, untouched. Banks view those stacks of bills as active capital. They take your savings and lend it out, or invest it into various industries to generate a profit for themselves. Traditional saving is a passive surrender. You are handing over the earning power of your capital to a third party, and they are keeping the results. The rising line represents a 3% annual inflation rate, the steady increase in everyday goods. The flat line represents your uninvested savings. At this intersection, rising costs overtake your stagnant balance. That widening gap is your lost purchasing power. If the cost of groceries and housing gets 3% more expensive every year, but your money grows at 0%, your wealth is evaporating. You're getting poorer just by standing still. To maintain your standard of living, you have to find a vehicle that grows faster than that baseline rate of inflation. This brings us to the core law of investing. If you want the potential for higher rewards, you have to accept a higher degree of risk. Let's grade some options on a tier list. Down on the low-risk end, we have assets like gold. We'll put it in B tier. It generally protects your purchasing power against inflation, but it generates zero new wealth or dividends. On the opposite end of the spectrum, you find high-risk plays. This includes the high volatility of cryptocurrency or the concentrated risk of a single real estate property. These assets offer the temptation of massive payouts. But they also expose you to sudden, catastrophic losses if the market swings or a property sits empty. Hiding in pure preservation or gambling on maximum risk are extremes. Neither offers a sustainable path for an average person trying to build long-term financial security. Many people try to find the middle ground through active investing. This is the process of analyzing corporate data, tracking market trends, and trying to perfectly time when to buy or sell individual stocks. The danger in this strategy is concentration. You are tying your net worth to the unpredictable fate of a single company. It requires constant attention and generates immense stress. Statistically, the majority of active stock pickers fail to beat the performance of the overall market over the long term. Trying to outsmart the global economy is an exhausting gamble that usually results in underperformance. There is a different vehicle, the index fund, or its cousin, the ETF. Instead of picking one stock, you buy a bundled collection, a tiny slice of the top 500 companies simultaneously. This relies on diversification. If a single stock fails, your portfolio breaks. But in an index fund, exposure is spread across hundreds of businesses. Even if one block shatters, the growth of the surviving companies offsets that loss, carrying the overall value higher. This approach captures the collective growth of these 500 major companies. You don't have to predict which specific corporation will win because you own a representation of the entire index. By spreading your capital across 500 different entities, you move away from the volatility of individual failures and toward the more stable growth of the broader market. To maximize an index fund, you need a behavioral strategy, passive investing, specifically a technique known as dollar-cost averaging. You invest a fixed amount on a strict schedule, ignoring daily market swings. When the market dives, automated deposits continue, acquiring more shares at a discount. As it recovers, those low-cost shares drive your returns. This removes emotion from the equation. It stops you from panic selling and ends perfectly timing the market. Automation is how you defeat your own psychological biases and maintain total discipline over your wealth. Beginners often fall into traps, panicking during a downturn, chasing get-rich-quick schemes, or investing money they need for immediate survival. If you avoid those traps, you unlock the final variable, time. This strategy operates across decades, allowing compounding growth to multiply your consistent contributions. Compare stagnant cash losing its value in a bank vault to 40 years of compound interest. One is a slow decline. The other transforms small contributions into significant wealth. Building wealth isn't an adrenaline rush. It is slow, steady, and relies on the quiet power of consistency.